Today, we're breaking down one of the hottest investment themes in recent years, the stock market performance of AI companies. Artificial intelligence is no longer just a tech trend. It has become a major driver of capital in global markets. But the key question is, have AI stocks really performed as well as people claim? Let's start with the big picture. Throughout 2023 and 2024, AI-related companies experienced a significant surge. Major players like Nvidia, Microsoft, Alphabet, and Meta were at the center of this movement. Take Nvidia, for example. Driven by massive demand for AI chips, the company saw extraordinary growth in both revenue and profits. This translated directly into a sharp increase in its stock price. Microsoft, on the other hand, strengthened its position through its partnership with OpenAI, integrating AI into its core products and boosting investor confidence. Similarly, Google and Meta accelerated their AI investments to remain competitive in this rapidly evolving space. But here's a critical point. The performance of these companies is not driven by the AI story alone. It is also supported by strong financials and established business models. In other words, investors are not just buying into future potential, they are also buying current profitability. Now let's go a bit deeper. We can broadly divide AI stocks into three categories. First, infrastructure providers. These include companies like Nvidia that produce chips, as well as cloud providers powering AI systems. Second, platform companies. Firms like Microsoft, Google, and Amazon that integrate AI into existing ecosystems. Third, pure-play AI companies. These are typically smaller, higher-risk firms with potentially higher upside. When we look at performance, the most consistent gains have generally come from the first two categories. That's because these companies are already large, profitable, and well-positioned in the market. So, is it all upside? Short answer: no. One of the biggest risks in AI stocks today is valuation. Many of these companies are trading at levels that already reflect high expectations for future growth. This means that if those expectations are not met, we could see sharp corrections. Another key risk is competition. The AI space is evolving extremely fast, and today's leader could fall behind within a few years. There is also the factor of regulation. Government policies around AI could significantly impact how these companies operate and grow. So what should investors do? A balanced approach is usually the most effective. Rather than concentrating your entire portfolio in one theme, it may be wiser to treat AI stocks as part of a broader investment strategy. Taking a long-term perspective and staying disciplined through volatility is also essential. To sum it up, AI companies have delivered impressive performance in recent years. But investing in this space requires understanding not only the opportunities, but also the risks. Because in the market, the most exciting themes often come with the highest expectations.